Initiative on Financial Security. I want to welcome you to the Institute and to what promises to be a really stimulating morning of conversation on the nation's financial system and the consumers who actually need this system to work. I founded Aspen IFS 11 years ago to push the thinking, the policy, and what I call the financial enthusiasm for products that would help all Americans to save, to invest, and to own. And for 11 years, our work here has been based on the guiding principle that you can't get to effective policy without leveraging the expertise of all the stakeholders. That means the policymakers, it means the experts and the people they represent, and the business community. So that's why I'm so pleased this morning, because we've got a distinguished group that has all of those groups. And we have with us, not only on stage, but in our audience, the kind of people who can really help us have an open and honest dialogue about the future of our financial system and how people are thriving in it. So this event takes its title from the legislation, Dodd-Frank, that was enacted in 2010 as a response to one of the country's worst financial crises. Some are truly still living with the effects of this crisis. Their homes are still in the midst of foreclosure, and they're not employed or certainly not earning what they're used to. And their bank accounts and their retirement accounts have not yet recovered. The crisis was truly severe for the American consumer. So let's take our minds back a little bit and remember what characterized this crisis and the Great Recession that followed it. Three things I'll mention: the credit crunch, the wealth loss, and the trust loss. So the credit crunch. Remember that during this last recession, credit flows suffered their worst slowdown since World War II. While in previous recessions, credit might have compressed by about 2% of GDP, this time they fell by 5%. And wealth losses were also severe. American consumers lost over $16 trillion in household wealth. Average family saw a wealth drop of about 40%. That's according to the St. Louis Fed. And a trust loss. In 2008, trust in the U.S. banking system was measured by Edelman at 69%. But in 2009, at the peak of the crisis, that figure had dropped to 36% had trust in the nation's financial system. So it's in this context that Congress moved to enact the Dodd-Frank legislation. The crisis had made clear that our financial system touched every American, even those that were underserved or outside of this. Whether it was student loans or credit cards or homes, Americans felt this recession and they felt the need for financial reform. As President Obama affirmed prior to signing the law, he said, ultimately, there's no dividing line between Main Street and Wall Street. We all rise or fall together as one nation. So when the Senate Banking Committee enacted the Dodd-Frank legislation, they said the purpose was to create a sound foundation for jobs, protect consumers, rein in Wall Street, end bailouts and too big to fail, and prevent another financial crisis. It was really the law that was supposed to set new practices to guide the financial markets, new rules to delineate systemically important financial institutions, increase capital ratios, and set processes for defining qualified residential mortgages. The fact that I can't say all those phrases and they don't roll off the tongue is where most people tune out. But really prominent at Dodd-Frank was really what it was doing for consumers. And that's what we're really here to talk to. You all know that there was a new Consumer Financial Protection Bureau that was established. And this was really a very new approach. So while Dodd-Frank was very focused on the system, it was a law that was trying to actually move consumers. So we're asking today, where are we? Where do we sit 4 years later? So some good things have happened. The trust numbers are up. Congratulations, industry. You're out of the trough of 36%, and you're up to 46%, according to Edelman. Hopefully there's way more to go. The CFPB has been established. It is a new cop on the beat, and it's credited with helping keep more Americans in their home and increasing scrutiny on student lenders and holding alternative financial services providers accountable. They've even refunded more than $750 million to consumers. So there is some change that's already happened. Recovery has started. Balance sheets have improved for some, but not all. I was last week at the conversation on the racial wealth gap, and I still find it shocking that after this crisis, we are still sitting with the fact that the average American and Latino household only 6 or 7 cents, respectively, for every dollar of wealth held by the typical white family. So we are not done. But today we want to look behind these wealth stats at the banking tools and the institutions that help us to build wealth. Basically, we can't close the gap if we're not actually working with the institutions that help us do this. We want to aim to dive a bit deeper on what's changed for the American consumers. There'll be plenty of other events in our city that track other aspects of the global financial system. But today we want to look at the experience of the American consumers and say, what's changed? And if it hasn't changed, why not? Our goal is that if we dig a little deeper and if we bring the best panel we've got, we'll be able to probe, are we really on the right track to improve the lot of the American consumer? What obstacles have been overcome and what remains? I could not be happy. This is the panel of our dreams. Let me explain. No. If you're going to talk about consumers and their money, this is the group. Melissa Coide, welcome. Melissa is the Deputy Assistant Secretary for Consumer Policy at the U.S. Department of Treasury. Melissa joined the Treasury Department to serve as Deputy Assistant Secretary, and she leads the department's consumer policy agenda, as well as the efforts to examine emerging trends in financial services. She supports the Secretary in his leadership of the Financial Literacy and Education Commission and serves as the Executive Director for the President's Advisory Council on Financial Capability for Young Americans. Prior to this, she was Vice President at the Center for Financial Services Innovation. She is a dear friend, and welcome back to Aspen, and welcome to the panel. We're very glad you're not just invited, but here. Thank you, Melissa. Also joining us is the Honorable Mark Morial, President and CEO of the National Urban League. As President of Urban League since 2003, Mark has been the primary catalyst for an era of change, a transformation for the nearly 100-year-old civil rights organization. He's changed this work to be truly dedicated to the empowerment agenda. Mark's distinguished resume includes entrepreneur, lawyer, professor, legislator, and most notably mayor of New Orleans, where he led New Orleans' 1990s Renaissance and left with a 70% approval rating. Mark, we're very glad to have you here back at Aspen. I bring greetings from your fellow New Orleanians, my president, Walter Isaacson, and we welcome you back. You've helped us with this topic before. We couldn't be happier to have you here.
Lisa. Thank you.
Joining Mark is the Honorable Tim Pawlenty, who is the President and CEO of the Financial Services Roundtable. The Financial Service Roundtable represents the leading financial service companies in their efforts to protect the security and integrity and success of our nation's financial system. Prior to this job, he served as governor to the state of Minnesota from 2003 to 2011, where he was responsible for a $50 billion biennial budget, 30,000 employees, and over 20 agencies and departments. This ought to make Washington a cinch. As you know, Governor Pawlenty was a candidate for the Republican 2012 nomination for president. He has joined us in Aspen before, and I'm very thankful you are here. Appreciate it.
Good morning.
Next to Governor Pawlenty is Jonathan Wetter, President of Retail and Direct Banking at Capital One. In this role, John provides strategic direction and leadership for the retail and direct banking operations, reporting directly to the company's chairman and CEO. He's responsible for more than 14,000 retail and direct banking associates, nearly 1,000 branches and offices, and has really put this retail operation on a path for very new growth and transformation. And we're very excited to have Capital One as a senior partner to the Aspen Institute's Initiative on Financial Security. John brings prior experience at McKinsey, at Wachovia, and at Morgan Stanley, but mostly he brings a passion for this work of meeting the consumer, as I'm sure you will see. John, welcome very much. Finally, so that I do not have to talk today, we found Lori Montgomery, the economic policy reporter for the Washington Post, who will moderate this discussion today. Lori covers the economic policy and the federal budget in the U.S. She focuses on efforts to tame the national debt. She's written extensively about every major piece of legislation to pass Congress since 2008, including the TARP bank bailout, the Obama stimulus package, and the Democratic overhaul of health care. She was, however, a former foreign correspondent who covered the emerging economies of Central Europe and the war in Kosovo over the late 1990s, which is why she's so skilled at unraveling complex issues like the financial system. She joined the Post in 2000, covering local government and politics. Lori has been with us in Aspen. We begged her to come back and moderate this discussion, and you'll see why. Thank you, Lori, and I will get out of your way and let you lead this discussion. Welcome.
So as Lisa noted, we're focusing on the consumer today. We're not going to talk about too big to fail. We're not going to talk about bank recapitalization. We're not going to talk about the Volcker rule in large part. We're going to talk about what happened for you and me in the aftermath of the crisis and how the government and the industry is trying to make things better for average people. And I thought we would try to do this in a little bit in two parts. One, government efforts, and specifically Dodd-Frank, the CFPB, and then branching out more broadly to what needs to come next in terms not only of government regulation and government legislation, but the industry and society at large. So I thought we would start with Mark Morial.
Thank you. Thanks, Lori.
Your organization, I think, was a big proponent of the need for Dodd-Frank and legislation. And I'm wondering if you could take us back to that time when things were pretty dark and paint for us what the experience was for the average consumer and what you hoped that this legislation would achieve.
So, first of all, good morning, and thank you, Lisa, and thanks to my fellow panelists. Let me try to answer it this way. Going all the way back to 2003 and 4, the National Urban League was part of a small chorus of voices who felt that the nation needed an anti-predatory lending legislative regime, because the advent of predatory lending and its explosion in 2003 and 4 were apparent, but the damage that it ultimately did was not apparent. So by the time you got to the Dodd-Frank time frame, we had been on record in recommending not anything as broad as Dodd-Frank, but something that would deal with predatory lending in all of its forms and fashions. One, the unfortunate practices of steering, where a qualified borrower who could take on a conventional loan may have been steered into a higher price predatory loan. Number two, terms and conditions in a loan which were confusing and tricky. Teaser rates, accelerator rates, high fees. Number three, no doc, no verification lending practices. You had a wide variety of things, and one of the things that caught our eye early was the elimination of a requirement that had been there for a long time, that borrowers avail themselves of housing counseling, which is financial literacy, home buyer education. So we saw that. So when Dodd-Frank and the crisis came around, it was tragic in its effect on the American people. If I fast forward to now, and I think this is a really important point, I think all of the discussions that we have to be integrated in, if you will, tied into a larger discussion of what's happening in the American economy. So, wage stagnation, low labor force participation rates, and finding ways to address those issues are crucial, because people can be intelligent with their money if they have enough to be intelligent with. If their money is completely taken up for the necessities of life, food, clothing, and shelter, sometimes the idea of saving and investing is nothing but an academic exercise, or something we talk about, but consumers cannot reach. So I think it's important to recognize that beyond the housing crisis, beyond the credit crisis, beyond the banking crisis, we had an overall economic downturn, and the forces of technology, innovation, and globalization have also hollowed out the middle of the American economy. A lot of blue collar, manufacturing, jobs in the Midwest, changing economy to higher tech jobs, jobs that require higher education, and an increase in the number of jobs that pay low wages, not just minimum wages, and alike. So you've got a lot of Americans working today. My best example is the cashier where I shop for groceries, who recognized me. I think I saw you talking about jobs. Can you help me find a job? I said, but you're working. She says, I'm a teacher. I'm doing this to make a living. I do not want to do this for too long. Many Americans find themselves in that position. So I think the underlying issue is that where we are today, we can talk about financial education, we can talk about reform of the financial system, we can talk about regenerating housing, we can talk about all of those things, but if we don't confront the underlying issue of low labor force participation, high unemployment in particularly communities of color among millennials, if we don't address the idea of wage stagnation, then what we're going to be doing is fighting a losing battle. And I think that's an important element that's got to be a part of this, is because the American people find themselves now in 2014 with these reality factors that affect their ability to qualify for mortgage. 2/3 of the American people have FICO scores lower than, 750? 2/3, right? So 2/3 can't even meet a minimum borrowing threshold for a whole host of financial products. We have to confront some of these difficult issues, which sometimes are on the perimeter, but I would suggest they're really not on the perimeter. They're really underlying this whole discussion. So I hope in today's discussion we understand how important an element this is.
So that segues nicely into the administration, which has been focused on a lot of these issues. Melissa, I'm wondering, when President Obama signed Dodd-Frank in July of 2010, he talked about reestablishing trust and transparency in the financial industry. And I'm wondering if you could talk a little bit about what the administration feels it's achieved on that score, but also it appears that the agenda is shifting more to these issues that Mark was just talking about.
Right. So I think Mark did a really nice job in summarizing the state of where consumers were. And I think he's also rightly pointing out that we are still in a state where people are, I think a recent Brookings report showed that 1/3 of US households are still basically trying to make ends meet. Trying to make sure that they are earning enough, that they are finding meaningful jobs with sufficient wages. And many are also beginning to think about how they're rebuilding their nest egg so that they have a decent option to turn to as opposed to high-priced consumer financial services, as well as the ability to begin saving for the short term that ultimately leads to some wealth accumulation for the long term. So there's no question that when we were looking at this a number of years ago, we knew that we needed better transparency in the financial services sector. We needed consumers who were more informed and who had more information about the various products and services that they had. That the financial services sector was also protected, consumers were protected against harmful practices. And so we clearly embedded the Consumer Financial Protection Bureau into Dodd-Frank, and that is a really landmark achievement. This is the first time we have a federal regulator that is focused on financial services and consumers' engagement with the financial services sector. That agency has done a lot of work. It is still a relatively new agency if you think about it in comparison to other agencies, but it has, based on research and analysis, begun to already define rules in the mortgage market. It has authority not only over the banking sector, but also the non-bank financial services sector, which is a really important part of making sure that consumers are protected across products that they may be offered. It also helps to set some, with that authority, it's helping to set some norms across industry so that we have consistency in terms of rules related to the products that consumers are using. So we think it is a really substantial achievement in terms of protecting consumers, and it's got more work ahead of it. One of the things that I want to point out about it, and as we think about where consumers are and where they're headed into the future, and where the financial services sector is and where things are headed, with the role of technology and the use of data, this bureau is also charged, or has set itself up so that it is looking at and promoting consumer benefiting innovations in the financial services market. So I will talk a little bit as we get in deeper into the discussion about how we are making sure from the government side, from the protection side, but also even from industry, what's happening in industry in terms of being able to give consumers the information they need to be making informed decisions about the products and services that they choose to use.
Governor Pawlenty, the financial services industry was somewhat less enthusiastic about Dodd-Frank. Your organization, I released in 2012 a fact sheet suggesting that there could be some costs for the consumer. In addition to reducing pre-tax earnings for large banks, the fact sheet suggested that there could be a 40% reduction in free checking. And I'm wondering if you could talk about, in the context of Dodd-Frank, are there trade-offs that we're making as we try to limit the risks but also expand opportunity?
Sure. Well, first of all, good morning, and thank you for being here. Thank you for being part of this discussion. I'm honored to be here with my fellow panelists and distinguished other commentators in this program. Thank you to the Aspen Institute for your continued leadership on the issues of financial security and financial empowerment. Lisa and her team continue to hold forums like this, and I think it adds a lot to the debate about where we have been and where we need to go. So I'm grateful for the chance to be here this morning. I think if you look at Dodd-Frank, one of the great benefits of Dodd-Frank for consumers is to decrease the likelihood that the devastation that happened to our economy at a macro level and at an individual consumer level will happen again. So if you look back and rewind the tape and see the unemployment that resulted and the catastrophic consequences of historic high levels of unemployment, if you see the decrease in assets and portfolios and access to opportunity and to economic doors opening because of the crisis and all the bad behavior that fueled the crisis, one of the biggest advantages of Dodd-Frank for consumers is to decrease the likelihood that that kind of scenario could unfold again in the future. I think before we look prospectively, it's also good to say, well, what were the things that caused the crisis, both to the betterment and to the discouragement and to the negative effects of consumers? And I think it's fair to say that one of the causes of the crisis was a coalition, unknowing coalition of both the right and the left, fueling really bad and unwise, and in some cases unfair, underwriting practices. And as we look back at that now, I think fair people would say, you know, there was a lot of really bad behavior and unwise behavior that took place leading up to the crisis. Some of it was well-intentioned, which is how can we loosen access to various products and services in a way to provide more opportunity, frankly, without regard to proper due diligence around some of it. And then also some bad behavior with respect to, you know, how that got done and the criteria that got applied, and that falls into the unfair category. So that plus more fueled the crisis. Our industry and our group understands and believes there needed to be a response to that crisis. There was going to be a dramatic policy response, and there was. So we think directionally Dodd-Frank is appropriate. Now, as it gets implemented and further implemented, we want to make sure that policymakers are taking into account the need to balance competing forces, which goes to the heart of your question. And one of those competing forces is, as you bring forward needed and appropriate and reasonable regulation, if the effects of that regulation are to so disqualify certain worthy or interested consumers in a product, or make it so costly, or make it so unaffordable, or more difficult to provide, have you then crossed the top of the bell curve to the other side, which is you're actually having the law of unintended consequences and doing some things that you really didn't intend. You know, so for example, and John maybe can speak to this more eloquently and specifically, you know, people have paycheck to paycheck lives, and obviously Mark's point is well taken. We should start all discussions with what can we do, not to be talking about financial literacy. We should be talking about how do you make sure that you have the finances to begin with to manage and the like. But for example, people live paycheck to paycheck sometimes need a little bridge loan or bridge credit to get because of an incident or a cash flow situation. And if you make overdraft protection so difficult or so problematic or so reputationally risky that you drive consumers from regulated institutions with reasonable costs and reasonable rules and fair rules to payday lenders or unregulated entities, there's still going to be a need, there's still going to be a market for that kind of gap financing. You'd like it to be in reputable places with fair and reasonable rules and proper regulatory oversight, but if you make that too difficult, too expensive, too costly, and you effectively drive that demand into unregulated, shall we say, less desirable places, that may not be a great trade-off for consumers in the long run. So as with all these complex and complicated issues, it's a matter of striking a balance. And then I'll just close on my opening comments and say I'm also excited about the future that was just touched on in terms of innovation and technology. There's a lot of things that are going to, I think, be very empowering, very educational, very user-friendly, very consumer-friendly, that are going to be unleashed not so much by regulatory regimes, but by the advance of technology as applied to financial services at a consumer level. And I think that could be very exciting and very helpful in terms of how consumers are going to be served in the future.
Mr. Witter, you have a unique sort of perspective, I think, on this whole thing. Your bank was praised by Richard Cordray for its response to the first enforcement action by the CFPB. Could you talk about that experience and what that tells us about the direction of federal regulation in this space and how it might be improved, whether it's appropriate?
Sure, and maybe as context for that, and actually before I begin, let me also thank my panelists, and let me also thank you for your both current and former service to our country. It's great to be here with you, and also thank you to the Aspen Institute. I think to understand our response to that enforcement action, you actually have to rewind the tape. In some cases, many years, and you have to understand what was going on within Capital One during that time. So if I go back even 4 or 5 years before the CARD Act, so Dodd-Frank aside, let's even go back further. I think we had two big revelations as a company. Revelation number one, which we won't talk about as much today, but I think it's important, is that the leverage model, the wholesale funding model that was taking root in banking, we weren't comfortable with. So we fundamentally restructured who we were as a company to try to make ourselves a safer, more resilient company in any economic environment. And the other thing that we realized as we looked across the industries that we served and the customers that we served is that there were just a lot of practices that we were not comfortable with. So again, before the CARD Act, before Dodd-Frank, we started a very open internal sort of strategy and set of programs to really tackle those kinds of practices sort of one by one by one. And so when Dodd-Frank came, we actually on one hand thought we were doing pretty well. But I will also tell you there was some great internal discussions where we really seized on the energy of Dodd-Frank. We seized on the energy of the financial crisis to really even more fundamentally question what were we doing as a company, what were we standing for, what did we really want to be for our customers. And I think in that context, we did a couple of very sort of immediate things. We've sort of immediately grabbed onto the CFPB complaint program, which we thought was a wonderful thing for the industry. And we did exactly what I think the CFPB wanted with that. We incorporated that into our customer listening programs, and in 1 year reduced our number of complaints to the CFPB by about 2/3. And that was really by going through and listening and understanding what was going wrong in the business and getting after it and fixing it. We very much took the lead on this whole notion of transparency. And with great leadership from the Pew, from great leadership from others, really tried to figure out how can we make it just so obviously clear to our customers what's happening in their financial lives. And we were incredibly gratified a year ago to be recognized as one of only 2 major banks in the country with a perfect transparency score in our disclosures to customers. We were very, very pleased by that. And so you can imagine, we very much felt that we were sort of on the right path here when the enforcement action came down. And if you talk to Rich Fairbank, our founder and CEO, he would describe that as the worst day in his life, bar none. Personally, professionally, it was an embarrassment to the company. It was an embarrassment to Rich. It was an embarrassment to all of us on the executive committee. And just for those of you who don't know about the enforcement action, the quick facts are we sold a payment protection product. This is a product to consumers if they had a need for some kind of credit protection. And it was sold by a third party. So it was not sold directly by Capital One, but by a third-party vendor. We had provided and approved scripts for the sales of that product. That, by the way, right there should have been a pretty good indicator that the product was too complicated if we had to provide scripts to our vendor about how they could and couldn't sell it. And while the disclosures, I think, were all right, what we found is that our vendor had gotten off of the major scripts. And quite frankly, we had not done what we should have done in overseeing that to make sure that that shouldn't happen. And so, we did what we had hopefully trained ourselves to do over that, that period of introspection, that many-year period of introspection, and we owned it. We absolutely admitted that, yes, we had not provided the right level of supervision. We did all the right things in terms of stopping the sale of that product, so we don't offer those types of products at all in our company anymore, not just in the credit card space, but across all of the businesses that we are in. And I think we really tried to meet the CFPB and Mr. Cordray where they were, which is really accepting ownership, but seizing on that energy and that learning to figure out how we were going to make our business better as a result of it. So we were pleased to sort of be held out as a sort of a model for how companies should respond to enforcement actions. I think we would have preferred not to have had the enforcement action to start with, but we absolutely own it, and it was our responsibility to fix it.
But there are other companies that still offer these products, right? I mean, is the system sort of set up to, and Cordray has testified before the Senate, I believe, at how pleased he was by the reaction of Capital One. But there's still, is there something that should be happening here so that there's a more even playing field?
It's a wonderful question. Thank you for that. And again, just as context, we as a company, I personally, are very supportive of Dodd-Frank. We're very supportive of the CFPB. Again, we think it is actually doing a lot of wonderful things for the industry. And it's provided us, I think, some great data and some great energy to really question some things that we do. With that said, as I reflect now, 4 years after Dodd-Frank, 5 years after the crisis, there are unquestionably things that maybe practices that aren't quite right or aren't quite robust long term. I think there are some unintended consequences of some things that we've done through Dodd-Frank and other regulation. And what I think of as some cumulative impacts. So lots of right-minded changes, but when you stack them all up on top of each other, you may end up with something on the other side that wasn't quite what you had planned. I think the enforcement action is a great example of that. So I would contend that one of the habits that's not a great long-term habit is the use of enforcement actions as a way of defining rules within the financial industry. And we are subject as an industry to the Administrative Practices Act. It's a very thoughtful way of thinking about new regulatory rule development. So there's comment periods, there's an opportunity for all industry players to get in and express their views. And at the end of it, the best benefit, and I think it's so at the heart of what Dodd-Frank was about, is consistent application of the rules. Right? So if we agree that payment protection products are poor products, then everyone should get out of selling them. If we believe that they're good products under certain circumstances, then we should provide them as an industry, but we should provide them within those guardrails. The use of enforcement actions has led to exactly what you've described. So we've decided as a company to get out of the product completely. And I think as we look at our competitors, they are on every sort of range of the continuum. There are some who are selling them exactly as they were sold, with what we would argue all the problems and issues of that 3-4 years ago. There are some that have modified their approach somewhat, and there are some like us who have exited the product completely. But if you go back and you think about the very tenet of Dodd-Frank, which is sort of consistent, consumer-oriented regulation, regardless of who the provider is, regardless of legal entity or structure or size, right? We've actually created a world through the heavy reliance on enforcement actions where we're working a little bit at odds of that.
Mr. Morreale, how much of an issue does this sort of these practices continue to be for the average consumer? I mean, you feel like the
I think that the average consumer faces today a far more complex financial system than they ever faced before. There was a time when there were two types of insurance policies, two types of bank accounts, one type of home mortgage. It was a simple menu of products. Now, in the world of competition and innovation, there are an array of products. The other thing that's changed is the propensity and predominance of technology-based marketing, telemarketing, internet-oriented marketing. So consumers are bombarded with a whole range of information, products, details, appeals that they've got to figure out a way to sort through. Even the most studied MBA or financial genius may have to spend time thinking and analyzing whether a product, whether a version of a product, every credit card is not alike. Every checking account is not alike. Every mortgage product is not alike. Every insurance product is not alike. So the complexity of the world that consumers must confront is so different today. So people want to know, who can I trust? Can I simply trust the idea that a product is being offered, that it's been sanctioned, like the FDA sanctions drugs? Or is it caveat emptor, buyer beware, let me be careful, and then if it doesn't work out, who do I go see? Can I get some recompense? That's the world that consumers face. So some consumers, when faced with that world, may engage in withdrawal. I will keep my money in cash. I will not deal with banks. I'm not going to invest because I think it's a gain. We have to build, that's where the trust factor comes in, but it's more than trust. It's also education. It's also information. It's also so consumers can understand and navigate the difference. I'm struck, so kids. So my children on the home television can make a financial decision. They can go to the on-demand box and buy a movie. You got to train them to check first. If they have a handheld phone, some apps are free, some apps cost. Some movies are free, some movies cost. They may not be as aware that by simply pressing that button or clicking yes, it's tied to your credit card, they're spending money. So I think we've got to understand that the world is different, and therefore we've got to equip and empower consumers. But I also think that the issue really is in Dodd-Frank. You know, it may be too far to say that the government should sanction products, but we've got to find a way to create in the consumer, not a caveat emptor arrangement. Because look, you take a Capital One, but then there's all of these new entrants. You had the private label mortgage servicers that contributed to the crisis, you know, in the 2000s, that were not regulated and didn't have CRA and didn't have SEC oversight, and they didn't have the regulatory regime that exists. So we've got to really figure out how you build this bridge. What's the proper mix between the rules and consumer information and consumer education, so that you have the proper marketplace. Marketplaces function on knowledge and information. An intelligent consumer, understanding the choices and the decisions. They function also on transparency and disclosures by the sellers of products, that sellers are going to provide basic information so that consumers, there's no hide the ball. That's why teaser rates was so tricky. You know, 1% for 3 years and then adjustable for the next 27 years. And consumers only saw what was there in the first years and didn't clearly understand what was there on the back end Therefore, they were not prepared for the resets and the effect it would have. So I think we have to find this. I think I've always been a believer that Dodd-Frank is good, its thrust is good, CFPB is good, but it's a balancing mix between a system that is so regulated that there's no movement, right, and the Wild Wild West, where there are no rules of the game, and everybody can do whatever they want, whenever they want. I think we will not know how effective Dodd-Frank is for probably 5, I think maybe really a minimum of 10 years. These types of reforms are for the long haul. You could not measure the effect of the New Deal reforms really until the late 50s or the early 60s came around. The effect all the way across the board of the time of the New Deal, followed by the war, and then the expansion of the it took a long time for those things, whether it was Social Security, the role of the federal government in housing, to really, really feel their effect. And sometimes I fear that our impatience and obsession with election cycles, news cycles, earnings cycles, takes away from us the patience to get it right, which is going to take time and I think a lot of tugging.
Ms. Quette, in what ways do you think that the banking industry and the products that we were just discussing have become more transparent and more understandable to the consumer? And where does the agenda go for the administration beyond enforcement actions? What more can happen?
I want to sort of put a caption on a lot of what you just heard, and I couldn't better support Mark's point that the notion of being able to do sort of a look back and assess how effective, really we won't be able to do that for a while because we are in a significant state of transition. Consumers are in a state of transition. They're trying to get back on their feet. Like I said, they're beginning to save. They're looking for ways of recovering their wealth losses. They're looking to get back into home ownership. The industry itself is in a very significant state of transition. We have a lot of non-bank fintech companies who are developing products that are really dynamic and quite powerful in terms of giving consumers real-time information about what's in their account, what goal they may have set, what they may be trying to achieve over the long term. You have the financial services sector, the banks themselves trying to assess how are they playing in light of these new actors in this market. And you've got, thank God, a new Consumer Protection Bureau, we can still call it new, who actually has the authority and the ability to look across and understand what's happening. I think, in some cases we're seeing the banks where they are acquiring some of these non-bank innovations companies. In other places we're seeing some of these innovators grow up and at least one has become a bank itself. It's just a massive state of transition, and it's I can't help but use this example. My son is here, he's somewhere in the room or he's left the room. He just had his birthday last weekend and he was buying, to Mark's point, an in-app purchase, a virtual good. I had my own mental debate about do I allow this purchase or not as his birthday present. But he kept bringing me his iPod Touch and saying, "Mom, put your code in and buy it," and I did, and then the machine would die and he'd walk away and he'd come back. Well, guess what? Monday morning I had a bill for $200. Yes. It was immediately addressed. But the point of the point of the story is, it's hard for us to grasp sort of how adults are managing their financial lives. Think about the next generation that's coming up and what are the ways in which they are making payments decisions and having credit options, and probably some very novel ways to begin saving that it's even hard for us to contemplate. The state of transition is significant.
But are there specific achievements so far? I mean, some things have happened, the qualified mortgages, there are...
No, and I think so. A couple things. One, in terms of what the Bureau has done so far that I think is worth calling attention to is some of the work in the non-bank space. The debt collection market, they've defined the credit reporting market, they've defined The student loan servicers has been defined, and they've set rules in those markets, and I think that's pretty important and pretty significant. The one thing that I think is also important for us to think about when it comes to the role of government, we have this very important Consumer Protection Bureau, but that's not all of what government does in terms of enabling and supporting consumers' access to, frankly, affordable products, their access to higher education loans, their access to savings products. Those are really important, necessary steps ultimately to get ahead and to be able to get to the point where you're getting meaningful employment and having a consistency of ongoing income that enables you to both sort of support yourself and support your children. So I can talk a bit more about that now, or I can hold off, but I think that there are some important developments that we have been working on, particularly around savings, that would be worth noting for this audience. Go ahead and jump in now. So some of you may have heard about this. The president announced it in the State of the Union address, the creation of the MyRA product. I'm looking at Eugene. This is a really significant and important product that we at Treasury, directed by the president, are working to develop right now. And it is a affordable, simple, and accessible, will be accessible savings product to help individual Americans begin to build their savings, both for the short term, but really importantly for the long term, for retirement. We have millions of Americans across the country who don't work for employers, but they're able to access a retirement plan. And this savings product will be the first step in terms of getting something that is reasonable to get into, $25 to open the account, minimum of $5 for ongoing savings to begin to start to build that long-term savings nest egg. So as we think about the role of government, both as facilitator of access to important needed financial services over the long term, is, I'd say, equally important to making sure that we have agencies, regulators that are making sure that consumers are protected.
And Mr. Witter and Mr. Pawlenty, what is the industry doing? Where are the gaps at this point? And how is the industry striving to understand the needs of consumers and how to help people do what we all want to do, which is save some money and build a future? How is...
Go ahead, John.
No, please.
Well, the industry's interests and consumer interests are aligned because industry would like more customers. They would like to serve more customers with more money. And so having growth in the number of consumers and the economic capability and capacity of consumers is in the interest of the consumers as well as the industry. And I like a point that Mark made earlier, which is this concept of balance. So if you think about it on a continuum from the Wild West to a government-centric model, between those two things where you have trying to preserve the best of what we have, which is the most innovative, dynamic, entrepreneurial, forward-leaning financial system the world's ever known, and then also making sure that it's not such a Wild West that you don't have proper protections and guardrails in place. There's a midpoint or a top of the bell curve somewhere along that continuum that strikes that balance. So on the industry trying to address consumer needs, one of the things that gets to your point about crowding out behaviors and market demand to places that are more troubling, like offshore places that are unregulated. Mortgage servicing was mentioned. So as the movement appropriately to try to tighten up the rules around mortgage servicing and all the reputational risk that comes with that has been unveiled, some pretty reputable institutions have said, and they're highly regulated institutions, have said, I don't think we want to be in that business. So they started to offload mortgage servicing to other places, so hopefully reputable and good places. But the net unintended consequence of that is to take mortgage servicing from big places with lots of capacity, with lots of regulators, lots of systems, lots of oversight, to now migrating it into spaces and places that may not meet that same definition. The future will tell, whether that's a good transition or not. But again, it strikes to the chord of striking the right balance as regulators step in. And then on the innovation piece, look, I was trained as a lawyer. I'm interested in these things. I talk about these kinds of issues. I get these notices in the mail. I mean, who the hell reads them? Frank, excuse my language. But I mean, a notice unread is no notice at all. So I mean, I get the stuff in the mail. If I want to get a product or a service, I have no choice but to sign the thing or check the box because I want the service. So I don't look at it, and I'm interested. I'm a lawyer. I've got time, to read this stuff. But think about a world where you now have an app, and this is probably more for next generation consumers.
My son.
Yeah, my daughter. You get an app that says you're about to authorize a payment for whatever. And a warning comes up that says, if you push pay, you're going to have overdraft. And if you have an overdraft, it's going to cost you this fee. Do you still want to make the payment? Yes or no? Now, that's a simplistic example, but it's a very different world where the simplicity of the kind of consumer interface that you have in the cab in Washington, D.C., where a big thing comes up and says, pick your tip amount, yes or no. Do you authorize payment, yes or no? That begins to make it much more, the consumer interface through technology, I think, can be greatly simplified, and notice can become more real and meaningful. I appreciate all the efforts to say from the regulators, have this kind of notice, have these kind of forms, click your heels 3 times, spin around. Nobody reads it. Nobody reads it. If notice unread is no notice at all.
I would certainly, Tim, agree with your points. I think the thought I would add, I am struck when I got into banking that banking is one of the few businesses out there that I think have 2 unusual characteristics. One, no one actually talks about the price for anything, right? You talk about the fee. And for anyone who's ever gotten a fee versus paid a price, I think there is a relatively significant sort of connotative difference between the 2. And I think as an industry, we have gotten to the point where we have lost sight of the fact that there has to be in every transaction a fair exchange of value, right? Customers need transparency. They need to understand what they're buying. If they want to have a more exotic product, they need to understand what's the value that they're getting from it. And they need to understand the price. And I would argue we're not ever going to get to a good place when it comes to consumer sentiment. We're not ever going to tackle some of these issues unless we figure out how to actually get to a clearer notion of fair exchange of value. I think the other part of it is most of the innovation that banks have done, right? And so I'm going to tell a little secret on my brothers and sisters from the industry, has been focused inwardly, right? It's been focused on how can I reduce my costs, how can I increase my efficiencies. It has not been focused externally on how do I delight my customers. And so I can't speak to how all banks are thinking about this, but I can speak to how we're thinking about that. So in our product design, we are dramatically simplifying. We still have choices. It's not a sort of a one-size-fits-all utility. But we've gotten down to a very finite number of products. So we sell 3 consumer checking products. By the way, incredibly clear, sort of, Q-esque sort of disclosures. Very, very clear pricing. Very, very clear sort of understanding of what drives it. Right? So that to me is a great hallmark. We've done that, by the way, not just in checking. We've done that in our small business space, in our credit card space, auto lending space. Sort of the list goes on. And we've literally gotten the feedback from customers that they don't like that. And the reason is because in their mind, they're still getting it free someplace else. And the reality is they're not, right? They're not. But we've made a strategic decision that we would rather go through that pain of having some customers say, this is a worse deal for me because I can get my checking account, in this case, for free over here. But do it in a way that long-term sustains and builds that brand relationship with the customer. So that's one part of it. The other part of it is we are massively increasing our focus on innovation, but we're doing it now with a customer lens. And there's a great sort of set of thinking really coming out of Stanford and the design school, the D School in Stanford, which starts with the very notion of customer empathy. Now, for anyone, and I am one of those geeky finance MBAs, but the power of starting with customer empathy in innovative and technological design, and the fundamental question being, how does this thing make life better for customers, is a huge paradigm change, not just for banks, but I would argue it is sweeping many, many, many industries. And I think if you can address those 2 things, really start to work toward a very clear, fair exchange of value, and really orient your innovation muscle to be customer back and for their benefit, I think you do have a chance to really change the game. That is a huge part of what we are banking our strategy on. But I think back to the point where it might take a little time for us to understand whether Dodd-Frank was successful. It will take time to change that. Right? I'm very realistic about the fact that as an industry, we have a brand. We have a set of expectations with customers, and it's not that. Right? And so I think the question is, how do you work at this in a very steady, predictable way, never varying? And I think there will be banks who do that over time, who really establish a very different brand and frame of mind with their customers. I can't promise every bank will do that, but that is certainly our intent.
So I wanted to introduce two things, because the conversation that you raised about focusing on the customer really raises what I think is a bigger discussion that we need to have around the overriding obligations of our major economic enterprises. So what we have in the country today is we have enterprises, business enterprises, for-profit enterprises that are far larger, more sophisticated and complex than our good old buddy Adam Smith ever envisioned. Adam Smith did not envision trillion-dollar enterprises with reaches across the seas. He didn't have a vision of that. That wasn't what he had in mind when he wrote Wealth of Nations. And I think that, and this is really a concept that was championed to some extent, I think we have to talk more about the stakeholder responsibilities of business leaders and the business leadership. So you're taught in law school, I'm a lawyer, MBA school, about the fiduciary responsibility to shareholders, the overriding fiduciary responsibility. But I think we need to be talking about the fiduciary responsibility to stakeholders. Shareholders are a stakeholder constituency for-profit companies. Consumers are a stakeholder constituency for-profit companies. Employees, when you've got 100,000 plus employees, are a constituency for-profit large enterprises. Community is a huge constituency. So I think we have to broaden the conversation because the economy and the economic concentration that we have today is very different in telecom, in banking, in a lot of places, in airlines. We have, and we've, the trade-off has been that innovation and economies of scale have meant that these kinds of enterprises have a benefit to the nation and to the community and the economy. They can innovate, they can invest, they can forward think. So I really believe that there's in Dodd-Frank and in the philosophy of what we need to be thinking about, we also need an elevated conversation about the responsibilities and the obligations. Because I think that business leaders today have a stronger set of community influences, bully pulpits, political persuasion than may have been imagined 30 or 40 years ago. And those times, I think, demand us to think differently. The other thing, and I can come back to this, I want to make sure, one of the important parts of Dodd-Frank that we worked for and fought for were the women and minority inclusion provisions, which were really, really important to us. And I want to use this frame because I think this is a frame of why women and minority inclusion in financial services is not just good, but good business. And that's because 7 out of 10 new families formed in the United States in the next 20 years are going to be from communities of color. Already today, the number of white babies and babies born from communities of color is about equal. We're facing a new set of realities, unimaginable 10 years ago. We've got millennials, then we've got, on the opposite side of the demographic spectrum, we've got an increasing number of people who are over 90. The number of 90-year-olders has increased by 30% in just the last 10 years. So when we talk about consumers, we have to also talk about that all consumers may not come from the same place, from the same situation, from the same vantage point, from the same perspective, and that large enterprises, to be able to serve those consumers, also have to think keeping things fair and keeping things reasonable and keeping things honest, differential consumer demand, needs, requirements, wants, and information perspective. So I think that we're looking with great anticipation as the CFPB and as Dodd-Frank sort of rolls out what these minority and women inclusion rules, regimes, thrust, and the most important thing, I think, is for them to take a leadership position, not just a regulatory position, but a leadership position to say to the industry and to say to consumers and to say to the nation, we've got to focus on this inclusion because the country has changed.
Well, on that note, I would like to elevate the conversation to the rest of the room if anyone has questions.
Can I just
Sir?
seize on that for a minute? What Mark didn't point out, first of all, I really agree with what you're saying in terms of the need to turn to our leaders, whether it's in the corporate community, the philanthropic community, to really lead and to give back and to be a part of the knowledge building and the engagement and the support for consumers, Americans. Mark sits on what we have just established, which is the new President's Advisory Council, focused on the financial capability of young people. And that really is a body that has been built by the administration to focus on how our corporate leaders, those from the academic community, philanthropy, not only coming together to help give advice to the administration about what we should be doing going forward, post Dodd-Frank, in terms of helping young people with their financial knowledge and skills, but also what they are doing as individuals and in their personal lives and in their professional lives to make sure that young people know about smart decisions. This new council has 4 major areas of focus. One of them, which Mark is leading, is around getting financial education into and related to the classroom. In fact, yesterday I was in Chicago with John Rogers, who's the chair of the council, and he was underscoring the point that we need to have more corporate leaders who are mentors and engaged in communities. Another one of the working groups is focused on higher education. I mean, it is just essential that young people are able to afford higher education, that they're able to manage their student loans when they're coming out. And this working group of this new President's Council is going to be very focused on that. And again, bringing the leadership from colleges, from the corporate sector, to really help make sure that we're doing this in a way that people are, that young adults are able to access and afford higher education. So thank you, Mark, for
Grateful.
agreeing to
Thank
be
you.
a
I'm
part of
following
that
you.
panel.
Yeah.
I have a question for you, Melissa. I have a friend who retired from the federal government, and she was advised by Rick Edelman, who's a well-known financial advisor, to roll over her thrift savings plan to an IRA that he manages. He charges 2% for his management fee, and the thrift savings plan charges 2.5 basis points. So his advice, which she trusted him and she took, raised her fees by roughly 100 times, and it's costing her a couple $1,000s a year.
So it's probably a more personal, not a broad.
No, I've done a paper that documents that this type of advice is widespread, that people are being advised to roll over the thrift savings plan to IRAs. And so the question is broader, though. The question is on
Where are
financial
people?
advice. This just is an example of very bad financial advice. The question is, who regulates this advice? Do they have adequate authority to do so? Are they doing a good job? Is there regulatory capture?
It's a really good question, and not knowing the particular circumstances other than what you said, I'm sorry to hear. It sounds like your friend was getting bad advice. The Department of Labor, who oversees ERISA And the ERISA plans would be a really important resource to turn to first. The IRS has some authority over these matters, and there are resources there with the IRS. Did you look into where she then sought information and advice in terms of how to manage and come out of the circumstances that she's?
Well, she thinks she doesn't understand this was a mistake. She trusted him, and she's proceeded with it. So and I haven't explained the issue to her.
Yeah.
Does
Department
FINRA
of
have
Labor.
responsibility for this?
SEC and FINRA might.
Well,
FINRA
FINRA
would
too,
be
but
the other one.
yes,
Yep.
SEC and FINRA too.
The SEC also, or?
It depends on the type of advisor, broker-dealer versus investment advisor. It depends on who that person is. SEC might have jurisdiction, FINRA might have jurisdiction, Department of Labor might have jurisdiction, IRS might have jurisdiction, so.
It depends on
It depends on-
specific circumstances and what
right.
information
I
she's
just, I'll
getting.
make one more closing comment. It seems to me like it's too complicated to
It is
determine the
complicated.
regulatory responsibility.
Mhm. No, your point's a good one.
I think we have a question here.
One of the things that you guys mentioned was just kind of the role of protecting consumers, right? And one of the things that you guys were also talking about was kind of making it more accessible as far as higher education and making sure that individuals were kind of taught some of these things in college. But it's a reality that everyone's not going to go to college. What about, has there been any conversations about maybe bringing that to the high school level as far as just knowledge about different financial institutions?
You know, I'll answer, it's a great question, it's an excellent point, and Melissa just referenced this. The new commission that the president appointed that I've got the honor to be a member of is going to focus on how we can bring financial education into the classroom. Because there's this whole remake of standards and curriculum taking place, and I think you're absolutely right. My gut tells me this. Our children need to be steeped and schooled in our political system, in our governmental system, in our Constitution, which is civics. And our students and young people need to be steeped in a basic understanding of our economic system and our financial system. And that's where financial education, financial capability, financial literacy can and should be taught in an appropriate way. And I think what we're going to do with the commission is look at best practices that are already out there, evaluate what the landscape is, and try to highlight. And really, I'd like to advocate for the inclusion of more financial education in the schools as early as we can get it and be appropriate. Because I think it's a demand and a command of the times.
Are you asking pointedly about decision-making around higher education, or what do young people know in terms of making decisions around financial products?
I guess, yeah, what I'm saying is what young people know about that, because it's kind of disheartening that the only way that, so for example, I just graduated this past summer, and I knew nothing about a lot of the things that I'm experiencing now until I started taking some econ classes in college.
Right.
And so I was really fortunate that I got that experience, but for my friends that maybe decided to not take econ classes, or my friends that didn't go to college at all, I'm not understanding why
Where are they
micro
getting
and
the information?
and why micro and macroeconomics couldn't be taught, for example, the same way that civics is taught in high school. So.
Yeah.
I would even break it down one layer beyond that, which is embedding personal finance concepts, practices, traditions, products, basic understanding products into school curriculum, not by creating necessarily a new standalone class, because that school's already overburdened, but as they teach math, as they teach science, as they teach social studies, there's no reason why you couldn't embed in existing curriculum exercises that relate to personal finance concepts. For example, one of the math assignments could be a math calculation, but it's in the context of a personal finance learning exercise and calculation. So there's a lot of work that needs to be done. There's groups who have surveyed the work of the states and local school districts on this. Many states purport to have financial education, financial literacy in their curriculum, but upon critical review, only a handful of states really have it done very well or very deeply. And so the work of trying to get other states and local school districts to put these kinds of concepts into the curriculum, into school standards is really important, and there's a lot of good work that can be done there, should be done there.
Hi, Gene Sterling from the Urban Institute. Sometimes confused with the Urban League, but I'm
Yeah.
always honored. I'm honored when that
I'm honored
confusion
too,
takes place. So my question is a pretty tough one, and I don't know the answer, but there is among us in this population what I'll call the lost generation. These are people 26 to 35 who have really lost out in this economic cycle. So if you go back 25 years, wealth in the economy, income in the economy's doubled. Those of us who are older, ours is on average doubled relative to our parents. Young people haven't gained it all. And part of what happened in the financial markets, particularly the housing markets, is you have these gains from, say, the late 90s to 2006. You have these gains from, say, 2010 to 2013. But they bought, right before the crisis. And now, partly because they bought and in some cases went underwater, have other problems, they can't buy. So we put them in this position of equivalent of buy high, sell low, and we're not going to allow you to buy now that we're putting all these subsidies in the system to the Fed and stuff like that. And I really worry about this generation and whether FICO scores are really treating fairly these people who are probably good risk, but basically excluded because something happened when they bought housing at the wrong time. I'm just wondering, both between the industry and the government, are there things that we could really concentrate on to help that particular, as I say, it really is almost a lost generation in terms of how they've got hit worse by this financial crisis. I should mention, by the way, it disproportionately hit people of color, which you mentioned
right.
as well.
Anyone like to
Let me
take
take a
it?
shot at it. One mistake we could make as a country is now, because of those experiences, to de-emphasize wealth building
Right.
with a foundation of home ownership because of the unfortunate experiences that we've had over the last 10 years. And I hear too many intelligent people whose own wealth, whose own parents' wealth, whose own financial security was created on a foundation of home ownership say we ought to rethink the entire value of a home being a part of the American dream. I think what you talk about is where one of the things we championed that did not happen early in the sort of bank bailout financial remake was the idea that there should have been built into the early stages principal reductions, which would have created for people an opportunity. If you own commercial property, right, and you want principal reduction, you head to bankruptcy court. And you can get mortgages reduced. Donald Trump can get it on all of his properties. Miss Sue in Northeast Washington, or that 31-year-old person who lost their job, couldn't get it. So I think one of the things when we rethink this is that had we done principal reduction and mortgage reformation so that the mortgages match the value after the collapse, what we would have given people is a fresh start or a new start or the ability to rebuild wealth. That being that as it may, maybe what your comments suggest is that for those who were particularly battered by the effects of the recession and are in that demographic category, we have to think of them in a very specific and distinct way to ask ourselves, what can we do today? The wealth losses, I'll give you this for the African American community. The home ownership decline was so significant that in 5 years, we almost lost 20 years of progress. So you went from where we were almost at 50% home ownership rates in the African American community to where we're down to 43 with a prospect of going even further down to 40. And that doesn't bode well for the rebuilding of wealth. So this is why it's so critical for us to recognize we remain in crisis. We remain in a period of working out. We remain where the best minds in the private, the public, the nonprofit sector have to realize it's not time to just say, by the way, the recession is over, the economy is fine, all is good, let's just go back to doing things the way we were doing it before 2007. So those are some comments on this, but I think this is one of the places where we differed with a lot of folks. We thought principal reduction should have been built in to all of the efforts that were made, well-intended, good efforts, strong efforts that paid dividends to help fix the mortgage crisis in the country.
And I would respond, and I know your research, thank you for presenting it to some of our councils. I think clearly there is a significant loss, but depending on which age cohort we're talking about, not all is lost. Notwithstanding the points that Mark is making, there are evolving products, government products, the MyRA product, that could be that starter longer-term savings product that those individuals could be beginning to participate in and reaching a threshold 15,000, where then they're rolling over into the private market and thus able to help recoup some of the loss. I mean, obviously they've lost ground and they have to make it up, but there are strategies in place to be able to help those that younger generation. I think also the fact that if we could get more information and really help to change the minds of young people about how important it is to begin saving in their retirement plans when they're offered by employers with the really significant matches, take advantage of that. I mean, those are ways for us to be able to help to begin to recoup some of the losses from that generation.
So I want to give you one other fact, right, because this is an important fact, another demographic fact. So 1/3 of all 30-year-olds today are going to live to be 100. So there's a lot of time. That's a stunning statistic, right? And, but apparently the demographic trend makers have suggested. So we're going to be living longer. We're all going to be living longer with, good health, and hopefully we'll all be able to be more vital for a longer period of time. So that changes the thought horizon on what you need to build wealth and for how long you need to build wealth. I think you're going to see a trend of people working much later retirements, and much more of an interest in people continuing to work because they want to be vital, they want to be relevant. And then those that have to continue to work because their retirement savings is not enough. So we have those sorts of changes. So that means that 30-year-older, there is an opportunity. They're not looking at a horizon of only till 60 or 65. They may be looking at a horizon until they're 75, 80 on average to kind of continue to build those nest eggs. But we need to pay attention to the devastating effect that this recession had on all those who acquired homes at the top of the market just before the recession.
Gina, I would just say don't forget the basic point, too, which is for most Americans, the main pathway to economic opportunity and stability and growth is whether they have access to a good paying job.
Yep.
And so it's not for today, but collateral to this discussion should be a discussion about what really are the things we can do to grow jobs, good paying jobs in this country, because there's all kinds of window dressing we can put around products and services and regulations, but unless you've got the core engine humming, which is the economy and the engine that produces jobs, the rest of this is somewhat secondary. So that's the key thing, and there's a whole discussion around how do you get an economy that's percolating between 1% and 2% GDP and has the lowest workforce participation rate in 30 years and has stagnating wage levels to be something better and different, particularly for people at the modest end of the income scale.
Questions back in the room?
Hi, I'm Nick Bork with the Pew Charitable Trust. I want to comment on two very important but somewhat contradictory themes we've heard about today. On the one hand, we are at a point where the consumer financial services market is more complex than it's ever been, as you talked about. A lot of choices, a lot of complexity, a lot of difficulty making decisions. And the trend now, we hear Capital One and other companies talking about simplifying, making the array of choices simpler and more streamlined. That's for the companies as well as for the consumers, I would think. On the other hand, we've heard about the trend of demographic changes, which require customized or new types of products just to serve new types of consumers. We've heard about technological change and some consumers making financial choices within their apps or on their phones. So we need more simplification, but we also need evolution. Innovation can happen in multiple different directions at once. So my question relates to what is the role of the government in helping to provide some good guidelines for these types of changes? And we've heard about the Consumer Financial Protection Bureau and its vaunted authority to look across different types of industries, banks and non-banks, to look at the same type of financial activity across the spectrum, whether it's made by one type of company or another. What role does the CFPB have in helping to foster good innovation and helping to set good guidelines going forward so that you don't have, like you mentioned at Capital One, you don't have as much of a problem simplifying your product lines and having a hard time because your competitors down the street are still engaging in practices that are really hard for people to understand and that hide costs?
I'm going to defer to the business guys.
Go ahead, John. Go ahead.
Yeah, I mean,
It's a good question.
you know, and I think it's a question that has so many different layers, and I'm sure we could have a deeper debate on each layer as we go. But in my mind, you know, there are some things that I think the government could do right away that I think probably most people could agree on. One, I think the whole notion around transparency is a big issue for us. And as we've gotten into the hard work of, you know, sort of untangling our products and our systems and sort of the way we go to market, again, what we find is when we go to talk to customers about, you know, sort of what we're changing, most of the time they don't actually understand it. And I'll give you, I'll give you a funny credit card example, which is, you know, hopefully all of you have seen our new ads for the Capital One Quicksilver card. And when we went out and actually talked to our competitors,
get one of those? Yeah.
we can talk after. When we talk to our competitors' customers, you know, do you know that your issuer puts caps on the amount of cash back that you can earn? When you know, do you know that you have to sign up for the special category each quarter or each month? Why? Because it's a good way of making sure that customers don't do it. There was an incredibly low level of understanding, even of those basic product features. And by the way, when you get into the more, sort of deeply sort of seated parts of a product, I think it gets even more confusing. So I am a big fan of transparency, and not just transparency in the disclosures, which I think, you know, a few of my colleagues up here have referenced. But to me, the test really should be not did I disclose, but did the customer understand? And if we're not willing to hold ourselves to that standard, did the customer really understand? Then I would argue that's going to keep going. Secondly, I think along with disclosure, I think there are some practices out there, and I think the CFPB has done a nice job with this, that really have no value whatsoever. And I think we should take a long, hard look at those as an industry and decide whether we want to just do away with those. I think the only thing I would sort of caution on is be careful of that. Because we've already seen in the last 4 years since Dodd-Frank was implemented a number of cases where there were features of products that were thought to not be valuable. And when you actually got in and talked to customers about it, what you found is that no, customers actually really valued those features. They knew exactly what they were buying. And to take those away would have actually been, you know, sort of real harm. But I think if you could start with those two things, you know, great transparency and some real guardrails around the, you know, the products and features that truly have no value to the customer, then I think you're off to the races. I think we can have a deeper discussion on, you know, on other layers of engagement that the government could be a part of.
So what should we get rid of?
What should we get rid of? Well, I've just named two. Look, I think there's all kinds of little nit-knacky things out there. You know, the one that I'll share, and we've not disclosed this publicly, but you know, we've made changes where, you know, a common practice that lots of banks engage in is they actually charge overdraft fees on held funds. And by the way, it's a relic of the way the world used to work, right? You know, if the funds weren't there and available, the account was overdrawn, and the systems weren't good enough to go back later and to actually say, well, no, the funds ended up being good funds, and therefore we should change it. We've actually made a decision as a company to move away from that. So we've invested an incredible amount of time and money into our systems, where now if you deposit an account and it's held, for whatever reason, it's a deposit from an out-of-state bank on an out-of-state check or whatever, and those funds end up being good, we'll go back retroactively and credit your account for that. You don't have to ask. We'll just go and do that for you. Is that big, glitzy, sort of change the industry overnight kind of stuff? No, but I would argue there's dozens of those little things
Builds
in there.
trust.
It absolutely builds trust. And it's hard to do, but we would take the position that there's really no value in that to customers, and it's something we've made the independent decision to change. So I don't want to sort of go through the whole laundry list. My guess is that there's probably some debate from different industry parties about which have value and which don't, and which are important for control reasons and which are not. But I think that's the thought process we should go through.
Yep. Yeah. We have time for one more question back here.
Okay, great. Thanks. Jean Hogarth from Center for Financial Services Innovation. I want to take us back to Dodd-Frank, and one of my concerns is always we seem to be solving yesterday's problems rather than dealing with tomorrow's challenges. And I understand we have to solve problems, but how can we be a little bit more forward-thinking in the way we approach the financial services marketplace for consumers today?
I'll jump in and just say, Congress by nature is a lagging indicator. So what they mostly do, I mean, it's very hard given the structure of Congress and how it gets assembled and how they operate for them to be vision casters and say, we see a future 10 years from now, we're planting a flag and we're developing a strategic plan and we're going to drive towards it, articulate it, execute it, and accomplish it. More typically, they respond to a crisis that happened or some eruption that happens, and then they spend time looking back through hearings, investigations, reviews, and then they craft a policy response to the crisis that was. So while we would hope for a different policy posture than that from Congress, by nature they are a lagging indicator. They are mostly a backward-looking institution. An executive, whether it be a governor or a president, has the bully pulpit. He or she can be the vision caster, create a dream, create a vision, rally public sentiment towards that, try to get support for it, and then, be that vision caster. And I think this president or any future president will have that opportunity, and there's some hope in that as it relates to these issues. But beyond that, I would say, look really to the innovators, the real innovators, probably not coming from government, frankly. So, if you look at the future of payments, for example, mobile payments, and you see what Google's doing, you see Apple's recent announcement with Pay with Apple, you look at how Amazon operates, you look at hundreds of new generation, new technology, financial service, apps, programs, software developments, companies. All of this retrospective around Dodd-Frank is going to happen simultaneously with a great evolution, and I would say disruption, in this industry where traditional financial service companies are going to look increasingly like technology companies, and some technology companies are going to look increasingly like financial service companies. It is all going to coalesce in the next decade or less about the same time that everybody's going to be doing retrospectives on Dodd-Frank, which may become increasingly less relevant as technology leapfrogs the whole discussion. All of what you've heard here today, think about how technology has taken complex things and reduced it to extremely, when it's well done, user-friendly, simple, transparent, interactive consumer experiences or individual experiences. We've just seen the glimpse of that, I think, and that's going to be a big part of answering your question. Probably, frankly, not coming from government officials, probably coming from somebody outside of San Francisco.
So I was going to add this. I've been looking for Nostradamus for a long time. But you just gave Aspen, I think, a great topic for another forum, which is really to have a discussion about what the future holds. What will the world be like 10, 15, 20 years from now? One thing we don't do is we really don't spend a lot of time discussing it because we're so focused on the immediate. the here, the now. And, you know, my organization I lead spends a lot of time future planning. It's a wrenching exercise to really force yourself to think about what things are going to be like even a year from now, 2, 4, 6, 8 years from now. So, Lisa, there's
Yeah.
another panel.
If I could make just one last thought. I'm haunted by your comment, and I was haunted before you even made it. You know, my concern is I actually believe we are at risk of entering into a real sour spot here. And you know, if I read the sort of the political tea leaves out there, and that's not my business, so it's always dangerous for me to do it. You know, my quick read is, you know, we have on one hand a group of people who say, well, we should just repeal Dodd-Frank, and anything short of that is a failure. And at the other end of the spectrum, I think you have people out there who say, you know, gosh, let's not touch Dodd-Frank, and let's not, you know, sort of, you know, pick up the topic of further regulation until we give this thing a chance to work. And you know, I'm struck by the comparison earlier to the New Deal, and the fact is, if you look at any of the great, you know, sort of regulatory regimes over time, it's seldom one act, it's seldom one piece of legislation. It's usually many, many. And what I sense today is a lack of a willingness and a dialogue to actually look at what are the pragmatic things that we can all agree on. What are the chances for us to improve what we already have so that we don't have to wait another 5 or 10 years and actually get to a point where now we have a new crisis to contend with? And how can we start to find agreement, you know, in those places where there is obvious, you know, sort of need for further thought and further change? And you know, I will tell you, as an industry participant, I don't sense the will today to actually really do that from any corner of it. And I think we will be at a loss if we can't figure out how to get that dialogue going. And that's what I hope is my next Aspen sort of dialogue, Lisa, if I can put it on the wish list. Yeah.
We have listened. This is what you come to Aspen for, to start the very dialogue that you all have helped us. The sectors you represent, the serious attention you've given us for 90 minutes. These are calendars I beg for, and all of these folks sitting up here have offices that are demanding them to get back. Thank you. Let me thank Lori. Let me thank John Witter, Mark Morial, Tim Pawlenty, and Melissa Coity. Thank you all.